So a value trap, as discussed by many people, a value trap is a stock that looks like it's a great deal but really isn't. The stock may look like a bargain because the company is trading at a low multiple, such as PE ratio, forward PE, could be low price to book value. With a value trap, these low multiples are also taken at face value without enough long-term or universal context to realize that you're falling into a trap. Now, one of the biggest telltale signs of value traps are companies that their revenues are going down or are going to continue to, let's just call it, go down over time, and the company's revenues are going to start going negative. This is something I've seen a lot of times with value trap type companies. It looks cheap. You're like, oh my gosh, the stock's trading at a 9 PE ratio and the market in general is trading at an 18. Oh my gosh, I'm getting such a great deal. Well, if the company's revenues are going to go down and down and down over the coming years, then you might actually be paying a forward PE that's much higher than 9. Maybe in 2 years from now, the company's actually much less profitable than they are today, right? And they also have much less revenues as well. So this is something that usually is a sign of, let's call it a value trap stock, right? Now, if we look at the stock prices of PayPal and Alibaba versus S&P 500 over the last number of years, let's call it over the last 7-8 years, something like that, it's very clear they have been value traps for the past 8 years or so. Both of them have significantly underperformed the S&P 500. If we look a little deeper here, the S&P 500, and this dates back to about kind of 2014, 2015 time, S&P 500 is up 141%, PayPal's up only 50%, so less than half of the performance, way less than half of the performance of S&P 500. Meanwhile, Alibaba stocks actually lost 21%. So not only did you way underperform just the stock market in general if you just invest in an index fund, but not only that, you also lost money. Like, that's crazy to think about, right? So clearly these two stocks have been, let's just call it what it is, they've been bum stocks over the past, let's call it 7 or 8 years. That's the bottom line with that, right? Now, are these stocks dirt cheap? Okay, could we even consider them potentially value traps? Because in order to be a potential value trap, you got to be at least dirt cheap. Well, if we look deeper here, we're going to find Alibaba is absolutely at dirt cheap levels. This company's trading at a forward P of 8. Based upon next year's numbers, a 7. Yes, that is dirt cheap on dirt cheap. I mean, most stocks in the market are trading at, forward Ps, I would say, probably in the range of 15 to 20 right now. Stronger growth companies obviously are trading way over a forward P of 20. So a stock like this is less than half of where the market's trading at. So that's dirt cheap, okay? Is PayPal trading dirt cheap? Absolutely. It's trading at about 12 times this year's expected numbers, right? They got one last quarter report here. And based upon next year's numbers, it's in the 10 to 11 range. That's dirt cheap. It's far, far, far cheaper than where the market in general is trading at. So at least we know these stocks are trading very cheap, so we can at least consider them potential value traps now at this point in time, right? Now, revenue. Remember I told you before, a telltale sign of getting into a potential value trap is a company that revenues are going to start going down. They're going to start literally declining for the business. And I'm not talking about the rate of growth. I'm talking about literally going negative. So 5% revenues down, 10% revenues down year over year. So where are the revenues expected to be at for these companies? Alibaba is expected to have about 7% revenue growth, then about 8% revenue growth the following year, 8.5%. So if they can do that, then this doesn't seem like nearly as much of a value trap as long as they can put up that sort of growth. That's nice growth. Is it double-digit growth? No. But 7-8% growth is still very nice. And if you can do that as a company over time, you're going to do very well for yourself. If we look at PayPal, same exact thing. 7 to 8% growth expected over these next few years. That's nice, solid growth. So if you're putting up those sorts of growth rates, you can't really fall into the value trap category unless your profitability erodes in a massive way, which means your spending went out of control or something like that. But the only way your spending is usually going to go out of control is if you recognize some sort of epic revenue opportunity. Usually companies that are great companies, which Alibaba and PayPal are great traditional companies if you look at the way they grow their business over the past 10, 20 years. These sorts of companies are not going to let their costs get way out of hand unless there's some huge revenue opportunity on the other side, right? Now, if we look at Baba, there's something very interesting that's going on with the business model that you have to understand. There's a change of the shareholder base going on right now, okay? Alibaba was an extremely strong revenue growth company for years. If we look here from 2014 to 2015, they grew their revenue 30%. The following year, 43% revenue growth. The following year, 58% revenue growth. Following year, 51%, then 36%, 34%, and then 37% revenue growth in 2021, right? So it's clear as day Alibaba was an extremely strong growth company, right? Now, we just talked about Alibaba potentially growing in the 7 to 8% range. That's a fundamental shift in terms of your growth rates, right? When you're used to a company growing 30 to potentially up to 60% to 7 to 8%, yeah, you're going to have a change in the shareholder base of people that are attracted to a stock like that. If we look at PayPal over the years, it was a very strong growth company, not nearly as strong as Alibaba, but it was still very strong, right? From 2014 to 2015, they grew revenues 15%. 15 to 16, they grew 17% revenues. 16 to 17, they grew revenues 20%. Then 18% revenue growth, 15% revenue growth, 20%, and 18% revenue growth in 2021. And once again, we're talking about a 7 to 8% revenue growth opportunity now for PayPal it's looking like. Now, keep in mind, these are analyst estimates, so they're not guaranteed. PayPal could grow much slower than this. PayPal could grow much faster than this. Just a little food for thought in regards to that. But the bottom line is the growth rates that PayPal expect over the next couple of years are not what they were in the last decade when this company was extremely strong growth. Okay, bottom line in regards to that. Now, both these stocks are at what I call a very awkward phase in their companies, in regards to their stock prices specifically. They're going from growth stocks to value stocks. And those are two very different shareholder bases. A shareholder base that, there's two frames of mind to keep in mind here. Okay, one is the shareholder base, and the second is what you're willing to pay for a company. So let's address the second one first, then we'll go to the first one. The second part, if a company's growing revenues 30, 40, 50%, a lot of times people aren't even worried about PE ratios. They just want in. They're just like, this company's putting up ridiculous growth. I don't care what the valuation is. I want in this stock. That's very different than if you're growing revenue 7 to 8%, let's say, for instance. Because if you're talking about a company that's growing revenues in the 5 to 10% range, you better care about valuation. You better care about forward PE. You better care about trailing 12-month PE. Those sorts of metrics all of a sudden are extremely important to you. So now, suddenly, everybody cares about valuation with these stocks versus back in the day, no one really cared about valuation because the growth was just so parabolic. It's like, who cares? I just need in this. If a company's growing those sorts of growth rates, 30, 40, 50%, like an Alibaba was, for instance, people don't care about valuation. They just want in, okay? The second component, which was the first component really, it has to do with the shareholder bases. You go from a growth investor shareholder base to a value investor shareholder base, and there's an awkward time that goes in there, right? Because the growth investors, they start to see all the growth go bye-bye, right? Which is obviously what has transpired in PayPal stock and Alibaba stock over the past 2 years, 2022 and 2023. The growth investors left both of those stocks, and they're saying, we want out. These companies don't have the growth they used to have. They don't want to be in a PayPal that has 7% growth. They don't want to be in an Alibaba that has 7% growth. They liked it when PayPal had 15% growth. They liked it when Alibaba had 30% growth. So those shareholders sell out. It takes a while for them all to dump. I mean, it takes them 2 years pretty much to get out of those stocks, to move out, right? Meanwhile, the value investor base, they're very patient. They take their time with these, and they wait for the risk reward to be so dang attractive that then they start buying in and buying in. But it's a transitionary period. It doesn't happen overnight. Because a lot of times people, when they think about a stock, like if a value investor looked at Alibaba, 3 years ago, right? Their mindset's already thinking about Alibaba as this crazy growth company that trades at crazy multiples and all those sorts of things, right? And if they looked at PayPal 3 years ago, same exact thing. They're mentally, there's like a block there that's just like, oh, PayPal's some crazy growth company that's trades at ridiculous multiples, because PayPal did used to trade at extremely high price to sales ratios, extremely high PE ratios, forward PE ratios, all those sorts of things. It used to trade extremely high. So the value investor base first has to get that old thought process in, like, their brains kind of being brainwashed to think, oh, those are extremely overvalued stocks that are trading at ridiculous valuations, to then saying, oh, wait a minute, these are actually stocks I should take a peek at. And oh my gosh, they're actually trading very, very cheap now. So then they start doing their research and they kind of go from there. But it's a process. And it usually takes, several years to convert a shareholder base from being that growth investor shareholder base to a value investor shareholder base. It's an awkward stage to go through. I've seen a lot of stocks go through it over time. And it's a process that just has to be kind of worked through. And that's part of the process that's being worked through on both PayPal and Alibaba stocks right now, right? So you have two sorts of, let's call it investors in what they look at. You have the folks that look at top line and they really care about revenue growth, how many customers they're attracting in the business, market positioning, those sorts of things. And then you got the folks that really care about the bottom line. They say, I want to know about the EPS. I want to know about the net income, right? I want to know how we're going to keep cost in line with this business. And I personally think you need to value both these things. I think if you are just looking at one or the other, you're making a big mistake. But this, I have to admit, like a lot of investors either fall into the top line category or the bottom line category. They're both so dang important. For instance, who's the king of 2023 for the stock market? It was NVIDIA, right? And so what was it that made NVIDIA stock the king of the stock market in 2023 over everybody else, right? Was it the hype? Was it the AI hype and excitement of everybody talking about AI? Is that what made them the king in 2023? The answer to that is absolutely not. If you believe that, then you've likely been brainwashed by bears that are going to say, oh, the only reason that stock went up is just because, there's just a lot of hype in the market and for AI products. No, that's baloney. Look at the fundamentals of the business. They've massively changed for NVIDIA. The hype and the excitement has nothing to do with it. It's all about how the business is doing. If you look at NVIDIA, their revenue started to explode. The top line came along, right? All of a sudden, next thing you know, the company's reporting revenues up 100% year over year, 200% year over year. Who else is putting up those sorts of growth rates? That's insane in this market, right? I mean, a lot of companies have been struggling to even grow their business at all. And meanwhile, you got NVIDIA saying, we're growing 100 to 200% right now. But it wasn't just the top line. It was the bottom line that followed. Look at this. From Q3 2022, right, which was their fiscal year 2023, but really 2022, 58 cents EPS, they went to $4. What is that, a 7x, 8x in their earnings per share? So their bottom line came up exponentially for the company. That's why NVIDIA was the king of 2023, okay? So this is important to understand these different dynamics to understand if you're getting into a value trap or not. Next one up here, I don't own enough of the mega caps, says Joe Terranova.
Get here.
So we're 7 trading days in, and you have to begin to ask yourself the question, okay, how long do you give it for the consensus to be right? How long do you give it? How long do you sit? Because last year I waited till April. This year I'm not waiting till April.
You're so far, year to date. You're going to give it 8 days? Or you're going to make up your mind after 7?
Well, you tell me. How do you respect what's going on in the marketplace right now? Do you respect the dominance of algorithms right now, in which the S&P equal weight, which was supposed to outperform, it's underperforming right now by 75 basis points. How about small caps? They're down 3% so far year to date. Mega caps. We were supposed to forget about mega caps. Guess what? You have a Mag 5. You know what they are. Exclude Tesla, exclude Apple. Don't run too far away from mega caps. And oh, Scott, by the way, how's your energy equities doing? Because everyone loves them.
Not mine.
Fundamentally.
They're yours.
Oh, energy is going to be the sector in 2024.
Because he's got like 10 of them.
That's right. I do. I own it. 2.7% energy equities are the worst sector so far year to date. Why are they not being bought? Natural gas is up 20%. Spot price of oil is up 1%. How long do you give it?
So what are you telling me? That
what
2024 is going to be 2023 all over again? We're going
to have... That's a risk, isn't it?
We're going to have mega caps outperform everything else?
That's a big risk for portfolio managers. So no one is going to be able to sit here and say on January 10th, well, at the end of the year, I believe that this sector or this equity size class is going to be the one that outperforms. As the year evolves, you reshape your risk according to what the market's doing. And what I'm telling you is January 31st, Joe T ETF will rebalance. I am in a period right now where I cannot make any individual changes to personal holdings of equities. I could do some options. I could do the QQQ, the SPY. But I'll tell you what.
So you could just get worked up and angry about it.
I'll tell you what. On January 31st, if this is the formation we have right now, I personally own Microsoft. That's not enough in the mega caps. I am personally going to have to buy some of the other mega caps, and it'll be consistent with what we do in the ETF.
Yeah, but what's going to be the pivot, though? What's going to be the pivot
What's that
between the pivot for you to say, okay, it's time? Because last year the market
We're already looking at that.
Well, I know this massive amount of PTSD last year, right? And then nobody trusted the rally. Like, this is just a BS rally. Nobody. Well, you did because you're really smart. But the majority of institutional investors missed the rally until March, and that's when they got into tech. They didn't buy tech until
I got it in April.
But it's just not. Yeah. It's not just those 5, though. I mean, you are seeing some rotation into some things that underperformed last year, and maybe it's more interest rate sensitivity. Maybe it's maybe that's why you're seeing utilities.
Utilities, does that get you excited?
Healthcare is the best performing sector this year.
Healthcare is. Now, does it get me excited?
Let me tell you
yes.
something. If utilities are going to lead the way in 2024, we're going to have a bad year.
Yeah. So
we're going to have an unexciting
year. What I would argue, though,
true statement. If utilities lead the market in 24, it was a rough one. Let's
2 and 16.
What I would argue is that there might be...
people don't know out there, what happens with utility-related stocks is those are stocks that people run to when they're extremely fearful, when things are really bad, things like that. So, if utilities lead the market in 24, it would be an extremely pessimistic sign for what actually occurred in 2024.
A perception, and I think it would be an inaccurate perception that right now this short-term strength in those more defensive sectors is indicating that we're entering a period where we are setting up for a more bearish tilt. I think that's overstated. I think that there is just a little bit of rotation right now, looking at some of the laggards, taking some money off the table, and perhaps in those 2 names or the other 4 names that aren't participating along with these 5, there could be a rotation.
Right.
So, but there are things that are doing well, Scott, that are outside of those 5 names.
But let's zero in on this a little bit more. This comes down to a debate, Carrie, over whether mega cap tech is too expensive or not. You come into this year, people say, well, valuations are too stretched, so therefore there's going to be a rotation into valuations that are more attractive and cheaper, right? Like some of the areas that we've already talked about, energy and healthcare, industrials and things of the like. RBC today downgrades tech to market weight from overweight. They say both valuations are now clearly expensive for the median stock in the sector on both an absolute and relative PE basis. This is where the debate begins and ends. Either these stocks are too expensive or they're not.
So let's talk about a couple things that already...
By the way, let me make this very crystal clear. That is a great situation to have. Usually you're on the right track if you want a stock where the only debate is, well, is it at an attractive valuation or not an attractive valuation? Is it overvalued or undervalued? This is a great sign because I can tell you that's not the situation for all stocks. There's a lot of questions about their business model, questions about this, competition, SWOT analysis, blah, 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 right? So if the only question when you go to buy a stock is really, man, I wish this was a little cheaper, you're probably on the right track. I'll just put it like that, okay? I mean, I own several of those stocks that would fit in that sort of category, right? And Amazon, and Texas Roadhouse, and Elf Beauty, some of those sorts of companies definitely fit that criteria of like, man, I wish it was cheaper. But if that's the only debate, that's a pretty good debate to have.
One is Joe's getting nervous. Look at Meta. Meta is the sort of name that makes people nervous who don't own it.
Meta's up almost 4% today.
Correct.
I wouldn't use the word nervous.
And it is, well, sorry, but I did already.
I would. Go ahead.
It's so close to its all-time high. I mean, people are saying better scramble and buy some because we haven't owned any and, just run and catch the train. And I think that expensive is not a term that applies the way sort of traditionally one would think of stocks.
3 years,
NVIDIA, people talked about it as being expensive. It turned out it wasn't expensive at all.
You know how much NVIDIA is up over a week?
12%?
14.
Okay. So, but on a PE basis, and we don't own it, but on a PE basis, it's not that expensive.
Exactly. Do you know how much the earnings are up, sir? Hundreds of percent, maybe 1,000% in some quarters.
It's expensive. Then, all types of names in industrials you could come up with. You could say that Google is not that expensive, and Meta isn't a particularly expensive stock. Salesforce on a PE basis now for next year is not that expensive.
Joe.
It's a little bit higher than a market multiple. So that's why people like Joe are saying, whoa, maybe we better buy them.
Because Joe is pointing out, making a good point about last year, where consensus was just dead wrong coming into 2023, raising the question as to whether consensus is dead wrong in the view of 24. Savita Subramanian, Bank of America, says Magnificent Seven expected to drive Q4 growth. So you're going to get your big earnings growth coming from those stocks, which makes it really difficult to look elsewhere. And yes, she's talking about NVIDIA, Amazon, Meta, Alphabet, Microsoft, and Apple, the biggest drivers of Q4 EPS growth.
And NVIDIA up 12% over the last 5 days. Where's the SMH? Is it the entire semiconductor industry that's rallying? No, it's NVIDIA. For whatever the reason might be, clearly investors, quants, algos, they want to own NVIDIA, and they don't have the same degree about the rest of the semiconductor industry, the same degree of excitement. And I think that's saying something about where ultimately the real growth is. The confidence in growth is with NVIDIA, not with the entirety of the semiconductor industry.
Perfect. So well said. Such an important point. People are looking for the most quality of quality to invest into in this market, right? And it's really been the story of really the past, at least year or two. The most quality is where people are looking. They're not looking to just buy semiconductor stocks in general. You buy all semiconductor stocks if you feel like all the semiconductor stocks are going to do well and it's a boom time for semiconductor stocks. You buy NVIDIA specific in non-semiconductor stocks if you feel like NVIDIA is going to do great, but not necessarily semiconductor industry, right? Two very different kind of viewpoints. And so I do agree with that. Like, people want to be in the best of breed. This is why stocks like Meta continue to perform tremendous. Amazon continues to perform tremendous. NVIDIA does, right? They want to be in the best companies that they're going to come through and just nail their numbers, a sales force, right? You want to be in the best of best, and that continues to be what performs very, very well.